model will help you understand the equity valuation, the process with the free cash flow of the firm, FCFF, and the free cash flow of an equity model. So the equity valuation model is very simple and the basic, but it's very fundamental, so that you can like utilize or develop from this the exercise for your real life example. Okay, the model is comprised of the discount rate inputs and the cash flows and the discount rate and the cash flow calculation based on the FCFE and FCFF, and finally we get this equity present values. So before jumping into this exercise, please read the textbook or hear the class notes. At least you must understand all these class notes concept first. Otherwise, it is useless to exercise through this the model. So first, we have to finish this discount rates input with unlevered beta because the company has a unique capital structure at the time we measure, but later on, this capital structure changes, right? That's why we need to calculate unlevered beta, 100% of equity financing. And we lever this beta with the forecasted capital structure. But we need to complete the input variables here, the cash flow input data and the discount rate to get this unlevered beta as well. And then here, the cost of equity and weighted average cost of capital. Here, cash flows input data, we use this PE ratio, the forecasting. If we forecast like 12 and the capital expenditures per the shares here, and the long-term debt to shares, EPS working capital, we need to make an assumption. In 5 years, what is the terminal target first, right? We want to achieve, But you must justify these assumptions on the research report with the very strong the supporting data, like research. And here, net income, depreciation as well. So this model produces just very simple progressive incremental changes of these other cash flows. So again, you must justify these project assumptions, project year assumptions. We are going to deal with the different corporate valuation model in the next the exercises. Is more accurate, but this is very fundamental and basic. If we assume the 12 PE and the 10 is the forward PE ratios, then how do you make this PE ratios, the incremental increase or changes to achieve this 12, the PE ratio? Yeah, we need to use some like a calculation process, right? So here, this number, right? This number 1 times, I'm going to explain why 1 times, and this the difference between these two, right, will be increased by 1 year. So how long years changes? Like 4 years, right? Between 2 years. First year we forecast 2023. It's because it's the arm's length. And here we want to be very efficient by putting the dollar sign here and dollar sign here. We want to fix this column cell, also this column cell, right? So that we can use this formula all the way down. So here, and then we got this forecasted. But we need to change this 2 years, right? Incremental changes, 3 years incremental changes to achieve this 12, the target PE ratio in 5 years. So let me just drag down, and we have this also the same, the forecasted cash flow input data. But here again, we need to change it to this, change it 3, change it 2, to same process. If we assume that all these input variables incrementally changes between these 4 years, to achieve this target 2027, just 5 years the target. So we finished the cash flow input data, right? Before the weight part and the level beta part, let's complete this cash flow again. Cash flow input data, the net income. Also, we have the same process here, right? Same process. I don't know if it is work or not. Oh, it's the okay. I think it is working, right? And let's just use one more. Then here we make this assumption tables. Next, we need to find these capital structures, right? And then calculate levered beta from this unlevered beta calculation. So we use the PE ratio. PE ratio multiples price divided by earnings, right? Where's the net income forecast? Here you go. So the market value of equity can be just PE ratio of the projected and net income. So we got this market value of equity. And then let's drag it to the right. So we have the assumption here, the forecasting, the market value of equity, right? Market price, the stock price times the number of shares outstanding. Once you got it, then we can calculate the debt to value, right? The debt to value. How can we calculate debt to value? Here, where's the debt? Long-term debt divided by, right, the shares, the book value of equity, and then one more time this, right? So we need to sum these two up so that we can get the total value. And this is the ratio. Let's drag it to the right. And here is the capital structure, right? The debt, the ratios, debt ratios. Now let's calculate, based on this, let's calculate now the unlevered beta. How to calculate unlevered beta? The current beta here divided by 1 plus 1 minus tax rate times now debt to equity ratio. We derived this, we proved this equation during the class. Please revisit the class notes and then you'll understand which equation we have to use. So again, unlevered beta, why do we need unlevered beta? We need to start from the pure 100% equity so that we can apply this different the capital structure of forecast year where we can calculate the cost of equity with the different the levered beta with the unique capital structure. So unlevered beta calculation, the current beta 1.3 now divided by 1 plus 1 minus tax rate 21%, then times what is the capital structure? Current capital structure 13,000 divided by now market value of equity, right? So let's close the parentheses. And 1.1672 is unlevered beta. Now let's calculate the levered beta. Levered beta here. How do we calculate this levered beta? Yeah, what function is now, what equation we need to use? Let me start from the last year. Now, once you got this unlevered beta, we have the unique capital structure. We use the levered beta of this equation. Is that right? So the unlevered beta, we need to now fix, right? We need to fix. That doesn't change. We need to fix. Now, times open the parenthesis. This is now the times. What we are using is this equation to get the level beta with the unique the capital structure of each project year. Now this is 6 times 1 plus 1, open the parenthesis, 1 minus tax rate. Let's fix this cell, and times, and what is the capital structure? Where's capital structure? Here we go. This long-term debt. Now divided by, right, the market value of equity. Then let's close. So we have now the beta, right? We have the beta. This this is from the unlevered beta. Now we get the levered beta with the capital structure. Now let's drag to the left. So we start from 1.3, and then we have the levered beta here. This case is very not much deviated levered beta because the capital structure doesn't change a lot. But if your case generate big difference in the debt to equity ratios, then you must identify how this levered beta changes a lot, because that affects the cost of equity calculation and the weighted average cost of capital. So how to calculate now the cost of equity? Cost of equity, based on the CAPM model. Where is the risk-free rate? There we go. So I want to fix plus, what do you need now? Yes, we need to get the market risk premium, which is the expected rate of return minus, already we got it, minus the risk-free rate, right? And then we can just fix this times now levered beta, right? So that we can get this cost of equity. Now let's drag to the right. So we have the cost of equity, very sophisticatedly, we got it. Now the weighted average cost of capital, you guys remember, right? The cost of debt, where is the cost of debt? There you go, 4.1%. Now we need to, this cost of, once we get this cost of debt, now we need to fix this, and then times now tax rate, because the cost of debt is the tax deductible. If you can make a projection of the cost of debt and the tax rate project year based on your strong assumption and research, then you can also build, right? But let's make it just simple. Then what is the debt ratio? There you go, we apply this, right? And then plus, now where is the cost of equity? There you go, times, then what is the equity ratio? Equity ratio, just 1 minus debt to value. So this is the equity, the weight. So let's close the parenthesis and drag to the right. So finally, we got this, the weighted average cost of capital. Again, this case is not much vary, right? Not much vary. But if you guys have the different capital structure of the forecast year, and it must be identified like this. Now, once we finish this, all the input variables part, then we need to calculate the free cash flows, finally free cash flows. So interest after tax is one of the cash flows, right? How to calculate it? Right, the interest, how to calculate the interest, right here in the equation, the interest, how to calculate interest of tax, the interest rate of debt, cost of debt, times long-term debt, times 1 minus tax rate, right? So the long-term debt times the interest we want to fix, if you assume that it's always the same, times 1 minus tax rate. We want to fix this as well. So we got this projected interest expenses all the years. Now, one of the component, what you're doing is here, right? The free cash flow of the firm, free cash flow of the equity. Now, changes in working capital. Changes in working capital is the number between 2 years. Where's working capital projected? Here we go. So minus, and the capex spending. We have the assumption capital spending here, capex spending here. This is must be also capital spending here. Capital spending per share times number of shares. Okay, then let's drag to the right. We have all these cash flows, right? But here the capex spending is not the changes yet. We need to calculate the changes as well. Oh, this is actually changes spending part. I'm sorry. Then now let's calculate the free cash flows. Right, free cash flow of equity. How do we calculate it? Right, free cash flow of equity here. Net income plus the depreciation, capital expenditures, changes in net operating working capital, and changes in debt. We directly calculate the free cash flow of equity. So free cash flow of equity, here we start from net income plus the depreciation, now minus, okay, the changes in working capital minus capital spendings, right? And plus, now what we want to see here, right? The debt part, right? If the company increases the debt, then we need to increase, right? Because that increase the cash flows for the equity. So we got this, the 7,436. So let's just drag to the right, only up to 2027. We'll calculate terminal value of cash flows. Now, free cash flow of the firm model, how to get it? Now we use this, right? Net income or EBIT times 1 minus tax rate, which is same. Net income plus interest after tax plus depreciation minus capital expenditures. The rest of them are same. What we are calculating is the cash generated by the entire firm, right? So here, that's why we need to include interest after tax from the net income. So net income plus the depreciation add back, because depreciation was not actual the non-cash outflow, but we counted this into the net income. That's why you need to add back. And the interest after tax, and minus the changes in working capital. Working capital asset increase, current asset greater than the current liability is cash out, minus the capital spending. So now we have this cash flow of the firm, right? Now, once we got this, the project cash flows, we need to calculate the terminal value. How to calculate? Based on the DDM model, right? Based on the DDM model, we calculate this times 1 plus. Now, the terminal gross rate. What is terminal gross? We assume here, right? It must be lower than the cost of capital, right? So here, now divided by what is the last year, the cost of equity. There you go. And minus, one more time, this terminal growth rate. So that we got this last year, the terminal, the value, cash flows. And then here was the same process times 1 plus growth rate, terminal growth rate, divided by now last year, the weighted average cost of capital. Now, here we must use weighted average cost of capital. Why? Because the company now we calculate the company's the cash flows. It must be, it must be definitely. It must be the weighted average cost of capital. That counted all the capitals, and minus where's the gross? Again, terminal gross, and finally we got 126,000, right? Once you calculate this free cash flows, now let's calculate present value of equity. So it's kind of like complicated, but you may remember the spot rate and the short rate in the bond, right? Because we have the different the cost of capital of each year, right? So we don't use every year we have a different cost of equity. We don't use just the one cost of capital, but each year we apply the different this short rates. So here the present value of the equity, present value of equity is now discounted by 1 plus this cost of equity, right? And the next, this must be now here we must also discount this the second year, right? Second year must be discounted by, right, this two short rate. Do you agree? Right, we multiply and then close one more parenthesis, and then we have cash flows. Likewise, next year also we need to discount the 3 years, right? What do you want? Multiply, right? The 3 years. And next year, the same process. We need to discount 4 years of this cash flows with the different, the cost of the capital discount rate. And here one more time. Here last year cash flows also. Let's just include one more year. And we got here. The last one, how to get it? The same process. This, right? I want you to just drag, but you get the right value. Instead, I want to put this, put this here, so that we got the permanent cash flows, the present value of the permanent cash flows, right? If I just copy and paste, and you will get here the present value of the free cash flow of the firm. Now we're almost done. Once you got the present value, what is the intrinsic value? Intrinsic value is the equity in the free cash flow of equity model. We directly calculate, right? So you can just simply the sum of this all, which is present values, and we got this, right? What is the equity value? Equity value is exactly the same as the intrinsic value, because there is no the debt consideration. We already counted the debt part, right? But here, what we calculate under this free cash flow of firm model is the entire business value, right? We need to subtract debt, right? So when we sum this up, here the total, the intrinsic value of the firm is 99 billion, right? We need to now subtract where is the debt. The current debt. There you go, right? The 13,000, right? So here the equity per share is now equity divided by number of shares at the current time. Here number of shares 17. Also we can calculate equity divided by number of shares 1700. Now we have the equity, right? The equity per share, if the market price at the current time is 40, right? Then what is this? So how do we calculate it? So we found, oh, it has the potential, the 30%, around 30%, both the present both the equity valuation method. So in this case, we can issue buy report. Depends on the some different criteria the investment bank has. They can put like hold or sell in a different criteria. Some company like has the range between 5%, negative 5%, which is hold, or 10%, negative 10% hold, and then above this hold range, they put the buy or sell, or neutral. Some investment bank, they compare the weighted average cost of capital 11%, then that must be greater than 11% to issue, to write the buy report, for example, right? So it depends on the criteria and the different condition. So you guys, see you in the next video clips. Bye bye.